Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So, interest rates, long-term interest rates, 10-year note and mortgages, stabilizing a bit this week. It was good to see the 10-year note yield, at least on here on a Thursday, remain beneath 150. And mortgage-backed securities, probably about 150 basis points off the lows of last Thursday, which, goodness, we hope that was the washout day. We hope that was the end of it, but we shall see. So right now, what are we watching? We're watching the Fed and we're watching inflation expectations. And the Fed doing its, kind of tiptoeing through the tulips and doing a lot of presentations here on a Thursday, Powell's up speaking and trying to talk about how inflation is nowhere near its target yet. Yes, it will rise as the economy reopens, but unemployment is nowhere near where it was pre-pandemic. So they're going to keep their foot on the gas and they're going to keep buying bonds, and rates are going nowhere, at least the Fed funds rate, for some time. Next week, we have some inflation numbers that we have to watch, CPI and PPI. Those will be important to watch. But I think the other big thing that you need to pay attention to is the long-term bonds, like the 10-year note, as they approach 150, maybe they go north of it. What could the Fed do to help pin down long-term rates? And whether it's a leak or whether it's a rumor, it's starting to percolate that the Fed may invoke Operation Twist 3.0. Now, what does that mean? They've done it a couple other times, back in 1961 and as recently as 2011. And it lasted from 2011 until 2013, 2012. And here's how it works. Essentially, what they do is they have this this multi-trillion dollar balance sheet, right? $7+ trillion worth of bonds. What they will do is go in there and sell some of the bonds on the short end. Let's call it 50 billion in notes and short-term securities, right, and bills. And they'll take that $50 billion, whatever proceeds they get from those sales, and they will purchase long-term bonds. And so this has a couple of effects. Number one, it stabilizes long-term rates. It's an overwhelming supply of buying, and it essentially kind of pins down long-term rates. And it also lets the market know that the Fed is buying, and it allows them to sop up whatever sales are out there. It also elevates the short-term end of the bond market, which helps also inflate the value of the dollar. And a stronger dollar is good for its anti-inflationary effects. If the dollar is strong, it helps in our imports and keeping prices down. So that's something you need to be watching and what it means for you and your clients. But remember that when they did this Operation Twist back in 2011, this manipulation of the market, because that's what it is short-term in nature. And in the last time they did this, the 10-year note between September of 2011 and December 12 went from a high of 3.75 to a low of 1.44. So it did have a material effect. But when the Fed got out and Twist was over, that yield quickly moved up from back up to 3% in a hurry. So something to think about as we go over the next couple of weeks, because not next week, but the following week, the Fed is coming. And if yields continue to tick higher, it'll be a problem. Hope this finds you well. Have a great day. Talk to you soon. Bye for now.